Welcome back. All right, we're talking to Lumax in focus after posting a stellar set of quarterly numbers with a healthy order book and strong EBITDA margin growth. But before we speak to Anmol Jain, Joint Managing Director, Lumax Industries, to understand the key growth levers, Puneet is joining in to set that conversation up. Puneet.
Well, thank you for that. Just 4 key points, as you rightly mentioned. It's been a very strong quarter for the company. Now, it largely operates in the lighting space, so has been a big beneficiary of the new SUV mix as well over the last few years, because the lighting industry actually has changed, going into LEDs as well as more stylish in that sense. So Lumax, both industries as well as auto, has been a big beneficiary of that. The second key one, a 30% revenue growth for quarter 4. Overall, also, it's been a very strong year for the company as well. And in terms of margin profile, that has improved to 10.3% now. So sustenance of that will be the second key aspect. Third one has been in terms of management chain. Anmol Jain, of course, we speak to him for Lumax Auto. Now is the joint managing director for Lumax Industries as well. And finally, the evasive question that if the merger between the two companies is on the cards, those are some of the key aspects apart from, of course, the growth outlooks amongst key factors.
And the growth outlook is a key factor simply because of the stellar performance in this quarter. Anmol Jain with us. Mr. Jain, thank you so much for speaking to us here at NDTV Profit. Always a pleasure to have you. What has worked for the quarter gone by? And it has, in a sense, also mirrored what's happened with the entire OEM space, right? Q4 has been strong all around. From what they're telling us, Q1 is as strong, if not stronger.
Thank you, Tamanna, for having me. First and foremost, Tamanna, Q4 was a stellar quarter for the industry at large. Our Q4 was the highest ever revenue in terms of Lumax Industries. It is driven by largely 2 or 3 things. One is, of course, the organic growth within the industry. Second is a higher wallet share concentration, which, based on our order book, we've been able to deliver. And third is, with the technological changes, the value content per vehicle continues to increase. So because of all of these factors, we could report a healthy 30% growth year on year in quarter 4. In terms of quarter 1, it's too early to tell. I think given the volatility which is there in the, whole supply chain as well as the war crisis, I still feel that quarter 1, we do not see any pullback on demand at the retail or the production levels. However, it's like a wait and watch. We're very cautiously optimistic that the growth momentum continues through the remaining part of the year as an industry.
So you're seeing no troubling signs so far, is the point that you're making in quarter 1. In your conversations going forward, is there any murmurs that you're seeing from key clients on concerns about consumption trends, etc., Anmol? Or is that skipping by completely right now?
Well, as of now, from a demand offtake, from a production, we are not hearing any murmurs of any downfall. However, the input prices have skyrocketed. I think it's unprecedented in terms of whether it's the manpower cost because of certain minimum wage hikes in certain states, or the input commodities because of the war, supply chain disruptions continue. So because of that, there is a lot of pressure on input costs. Of course, we are hoping that we will get compensated from the OEMs. It's usually a time lag of 3 to 6 months, but it's going to be a wait and watch, with the increase in fuel prices, which the government has recently announced. And I personally feel that there will be perhaps a lot more fuel price hikes going forward. So given all of that, one will have to wait and watch in terms of the real demand offtake, whether it does taper down or it still kind of holds steady. You have to understand that last year, quarter 3, post the GST rationalization, there was actually a massive price drop in the hands of the consumers. So even after these price escalations on account of input cost, oil prices, I still feel that there will be a certain delta in terms of end price saving in the hands of the consumer. So we'll wait and watch. But as of now, we're not hearing anything in terms of pullback on demand.
Yeah, Anmol, good morning. Neeraj here. We had a I wouldn't say a peer of yours exactly, but from your sector, if you will, 3 or 4 days back come in and say that if the momentum continues, the current year, which is FY2027, could turn out to be the best year in history. So I'm now kind of flipping the tone and asking you that if you were to look at a blue sky scenario of things staying as they are and not worsening, could you actually have amongst the best years that you've had for your company as well, historically?
Well, definitely, Neeraj. I think if the momentum continues as an industry, year on year, we've actually outperformed the previous year in terms of industry numbers. And even if the growth were to slow down, we will end up delivering a lot more units for the year compared to where the industry stood in FY26. So definitely, if the growth momentum continues, we will look at one of the highest record years again. And I think the investment cycle is something which continues. I don't think there is a stall on the investment cycle, whether it's at the OEM end or it's at a tier one end. People are investing in expanding capacities, and we're no different. We have a solid order book, and again, auto industry usually works. And someone like Lumax for the lighting systems is an early onboard supplier. Usually, the lead time is about 2 years from order to SOP. So we will continue with the investment cycle, hoping that the growth momentum also continues.
Just one more point is on how you mentioned in the earlier part of your conversation about input costs becoming a point to watch very carefully. But this comes on the back of a year wherein you've had your highest EBITDA margin, if I'm not wrong, in last many years, right? Which I mean, your EBITDA growth was way stronger as a year than your revenue growth, which is music for the ears, I'm guessing, as an entrepreneur. My question is, can you maintain this, or is it difficult to call that out in a year which has got these, these issues surrounding us right now?
I think the EBITDA margin expansion was largely on account of a few things. I think number one being the operating leverage. I think with a 23% growth year on year, there was a lot of operating leverage which we saw. Also, there was a lot of prudent cost management. So all of that put together, and in certain cases, some of the new order book did yield a better material margin for us. So all of that has led to a margin expansion. I do believe that we should be able to sustain the current margins of double-digit EBITDA. And again, if the growth momentum continues, we'll probably also have an upward increase on the margins by perhaps 30 bits or so for the full year FY27. The margin pressures continue because of the input costs. But again, as I mentioned earlier, we do have a kind of an understanding with the OEMs that, with a time lag of 1 quarter out, we should be able to get most of these price escalations compensated.
Mr. Jain, you mentioned earlier in this conversation that you hope OEMs will accommodate the price rises that you have suffered, input costs as well as labor, etc. Is this right now a grey area? Is this conversation on? Is there clarity if you will have to absorb those price hikes, or will they be passed on?
So, Tamanna, I think the OEMs are pretty fair that the price escalations will get eventually passed on to the tier one. I don't think the question is whether they, give you the price escalations or not, because again, a few percent here and there, I think we all, through certain improvements, are able to absorb. But as I mentioned earlier, the price escalations are actually unprecedented, where we've seen certain commodity prices go up by 30, 40%, manpower costs go up by almost 20 to 30% as well. So it's not the question of whether they will compensate, but more importantly, how soon can we get this compensation? Because it does put a lot of pressure on the cash flows. And traditionally, we've seen a 1 quarter, 2 quarter lag when the price corrections are done. But we are hoping for price corrections to happen sooner, probably on a monthly basis for certain commodities, or at least a bi-monthly or quarterly basis for the rest of them.
Okay, thank you so much for speaking with us. Anmol Jain, Joint Managing Director, Lumax Industries, is joining in for the outlook for FY27, which is looking bright, but everything right now is with conditions attached, I think, for all companies and industries. That was not quite the case in Q4. Q4 had a mix of a fundamentally strong quarter with a bit of a hint of